Welcome back to Sustainability Ventures, where we go beyond the headlines and break down the real power structures shaping the energy transition, Earth, charts, and buildings. Today, we're tackling a question most investors never ask. ESG ratings influence trillions of dollars in capital, but who influences the ESG ratings themselves? More specifically, how do asset managers shape ESG rating methodologies? Because when capital allocators with trillions under management speak, rating agencies tend to listen. Let's unpack how this ecosystem really works. First, let's clarify what ESG ratings are. They're scoring systems developed by firms like MSCI, Sustainalytics, S&P Global, and Moody's. These firms evaluate companies based on environmental risk exposure, social performance, and governance structures. The scores influence ETF construction, index inclusion, pension allocations, and institutional portfolio decisions. In other words, ESG ratings shape where money flows. But here's the nuance. ESG ratings are not regulated like credit ratings. There's no universal formula. Methodologies differ significantly. And that's where asset managers enter the picture. Global asset managers control staggering amounts of capital. Firms like BlackRock, Vanguard, State Street Global Advisors collectively oversee tens of trillions of dollars. When these institutions design ESG funds, they rely heavily on external ratings providers. But here's the key dynamic. Asset managers are not passive consumers of ESG ratings. They are major clients. And when your biggest clients manage trillions, their preferences matter. Let's break down the mechanisms of influence. 1. Methodology consultations. ESG rating agencies frequently update scoring models. Before changes are finalized, they open consultations, often inviting institutional investors to provide feedback. Large asset managers submit formal responses. If a trillion-dollar client argues that certain carbon metrics are too heavily weighted, that feedback carries weight. When asset managers launch ESG ETFs, they define screening criteria: fossil fuel exclusions, carbon intensity thresholds, diversity metrics, and governance risk weighting. Asset managers adapt products to meet this demand. If asset managers prioritize climate transition risk, methodologies evolve to reflect that. Some asset managers build custom ESG frameworks in partnership with rating firms. For example, custom low-carbon indices, climate-aligned benchmarks, net zero tracking metrics. These collaborations can gradually influence broader methodology standards. One of the most debated issues in ESG is score divergence. The same company can receive a high rating from one agency, a mediocre score from another. Why? Because methodologies differ in weighting environmental versus governance risk, industry-specific risk models, data interpretation, forward-looking versus backward-looking metrics. Asset managers care deeply about consistency. If ESG scores vary too much, it complicates fund construction. So what happens? They push for standardization, clearer disclosure rules, and transparent weighting criteria. That pressure doesn't rewrite methodologies overnight, but it shapes the direction of travel. Regulators are now paying attention. In the European Union, ESG rating agencies face increasing scrutiny under sustainable finance reforms tied to the Sustainable Finance Disclosure Regulation. In the United States, the U.S. Securities and Exchange Commission has proposed enhanced climate disclosure requirements. As regulation tightens, asset managers often lobby for clearer data standards, comparable metrics, and reduced greenwashing risk. But remember, large asset managers also manage index funds that hold nearly the entire market. They must balance climate ambition with fiduciary duty, so their influence isn't purely ideological, it's strategic. At the end of the day, ESG ratings don't exist in isolation. They are shaped by data providers, asset managers, regulators, and corporations. Capital markets are not just reacting to sustainability standards, they are actively shaping them. So here's my question for you. Should ESG methodologies be standardized by regulators, or should market forces continue to drive evolution? If you found this breakdown valuable, hit like, subscribe, and share this with someone who thinks ESG scores are purely objective numbers. Because in global finance, methodology is power.